Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The fact of the matter is the global rate cutting cycle is already well underway. We track 37 central banks, 20 of them are already cutting rates. The Fed's going to join the party probably at some point this year. We're 90 days away from the September Fed meeting. Traders are pricing in a 67% chance that that's the first cut. And I think that's what investors need to focus on.
Buyers, they've pretty much become acclimated to these new mortgage rates. I mean, obviously 2-3% was at the historic low, but even at 7% historically, those numbers are low from a historic level. And again, even though they've risen over the last couple of years, they are low by historic standards.
Darden is the best bellwether for full-service restaurant stocks in the space that we cover. They've continued to see a little bit of pressure on the low-end consumer. But one of the things that I thought was really interesting from the earnings call this morning was that they're actually seeing a little bit less check management on the business as a whole.
We've got 1 hour to go until the market close, so let's take a look at the major averages here. We've got a mixed picture with the Dow, the winner of the day, switch from lately here, up almost 1%, about 356 points right now. We've got the S&P 500 down about 1/5 and the Nasdaq down even more, about 0.9%. Not a lot of fundamental news driving markets today. We did get jobless claims more or less in line this morning, and we also got housing starts data this morning. That doesn't seem to be having a huge effect here, as we see also yields climb a little bit. If you looked at what was going on in the bond market earlier, we were seeing on a price basis it coming to sort of even year to date. What's also interesting today is what we're seeing in some of the large cap tech stocks, which earlier had been climbing, and now we are seeing more pain. Nvidia, Apple, Microsoft are all in the red today. In fact, seeing some selling elsewhere in chips. Broadcom, for example, also pulling back after we had been seeing a gain recently in some of those large cap tech stocks. And if you look at the XLK is the tech index, that is the worst performer today. We've got energy is the big winner, along with oil prices climbing. Utilities also doing pretty well. And tomorrow, Josh, we have witching. The expiration of futures and options contracts is going to be a big one, so there could be some volatility going into that.
All right, we'll be waiting and watching. Thank you, Julie. For more on the markets, joining us now is Dan Skelly, Morgan Stanley Wealth Management Managing Director, Head of Market Research and Strategy Team. Dan, it is good to see you. On the Fed, Dan, I thought you made an interesting point here. You say the longer the Fed keeps rates restrictive and allows lagged effects to impact the economy, the more the haves and have-nots may diverge. What did you mean by that, Dan? Walk us through it.
Sure, Josh, and thanks for having me back on the show today. So, simply put, we have seen certainly a set of mixed data across the economy, across the consumer environment. But I think more and more we're getting clarity that, like I said, the longer rates stay higher, the more you're going to see this divergence between certain corporate and consumer cohorts who are more rate insensitive and those who are less rate sensitive. And frankly, you can intuitively think about all the different applications of that concept. But on the consumer front, it's playing out in terms of high income versus low income, homeowners who have fixed mortgages versus those who are maybe trying to buy, and then, of course, renters. On the corporate side, look, it's the reality that there's a certain cohort of large companies that have net cash balance sheets, and they're actually seeing their interest income exceed interest expenses, given the rate environment on the short end as well. And then there are companies, frankly, more down the cap curve in small cap land who have more leverage, who are, frankly, seeing the pain from high rates.
Dan, it's Julie here. So as you look at that have and have-nots then scenario, what are the implications then for the economy and the markets? Because we've heard a lot of economists come on the show and talk about how the upper echelons of income account for the bulk of consumer spending anyway. So, talk us through sort of the implications of what you're saying.
Julie, it's great to be with you as well. And you make a really astute point, which is, mathematically, if the top income cohorts account for the majority and the lion's share of spending, if that second track starts to degrade or slow down, can that actually move the overall averages? And our view is likely not. So Morgan Stanley, from a firm perspective, is still in the soft landing camp, right? So we still see, albeit two-track divergence amid these different groups, we still see the overall picture as fairly positive, but it puts the Fed in a really tricky place because, frankly, just keeping rates higher isn't necessarily changing the behavior of the one track that isn't rate sensitive, right? And in some instances as well, if you're cash rich and you're now seeing 5% yield on cash, you're then taking that income perhaps and going out and spending more, which, you can make the case, it's a bit counterintuitive, but you can make the case that rates staying at these levels perhaps is supporting high inflation in certain services.
So Dan, if that's sort of your views on the Fed, the economy, where we're at and where we're headed, what are the investment implications, Dan, for equity investors listening right now?
Absolutely, Josh. So I'll say two things. First, in the near term, it's just more of the same, right? It's not trying to get too creative by fighting the momentum in some of the larger cap, cash-rich type business models who are not only seeing the benefit from essentially being insulated from high rates, but also benefiting from these idiosyncratic spending trends, whether it be in the tech sector or semis or in some of the internet and software areas, whether it be in the industrial sectors where you're seeing massive fiscal spending on certain priorities. You essentially don't want to fight some of the earnings power, some of the momentum in these areas. Having said that, though, Josh, the second thing I would say is you want to start thinking about a world like 6 to 12 months from now where, frankly, some rotation may start to finally occur. And what would we be thinking about in terms of those themes? Well, look, our base case, again, is a soft landing scenario where the Fed is cutting later this year. Alan Zettner, our economist, who I think has had this call as close to spot on as anyone, is still looking at potential for 3 cuts this year. And so at a certain point, Josh, the puck is going to start going to more value-oriented parts of the market, more, frankly, cyclical parts of the market. And that is something we are thinking about coming into the end of this year.
I was going to ask about timing there, Dan, because that is a call that, that's out there that hasn't yet come to fruition. Is the signal for that going to be when the Fed starts cutting? And by the way, as we're talking about cutting, I think the last time we talked to you, you were still looking for 3 cuts this year, and I wonder if you're still there.
Sticking with 3, so I'll answer the second part first, which is, we had thought the path of disinflation would be lumpy in the first half of this year, and that played out to a T. The first quarter had some seasonal factors. It had some issues that certainly we thought were more one-off. And look, as per the last 2 months of data, it does look like that glide path towards the Fed's goals are more in scope, right? And so we do think the path of resuming disinflation is getting there. And look, importantly, as you know, the Fed has explicitly said, we're not going to wait to kind of stick the 2% landing exactly before we start cutting. And frankly, I think that's pretty wise because, as you know, there are structural issues that have frankly built up since the post-08 environment in terms of housing supply, in terms of labor shortages, that frankly, I don't think we're going to really solve with any type of monetary policy in and of itself. And so I think if the Fed sticks to that guidance in terms of not waiting to the 2% landing, I think you can start to think about positioning in some of those value parts of the market coming into this fall. Now, as you said, a lot of people have tried to make that call so far. It's been difficult because, frankly, a lot of the fundamental earnings revision, like I talked about, and momentum has been in some of the other growth sectors.
All right, Dan, thanks a lot. Good to see you. Dan Skelly, great to talk with you again. Super Microcomputer and Dell will provide server racks for the supercomputer from Elon Musk's startup XAI. The shares were higher earlier, now they are not, which maybe says less about the news itself and more about where we are in this market and the sort of waning enthusiasm, at least for today, for some of these stocks, because we started to see Nvidia roll over, then we're seeing Dell and Supermicro roll over as well. All three of these stocks, by the way, involved in this. Michael Dell announced all of this on X, saying we're building a Dell AI factory with Nvidia to power Grok for XAI, and then Elon Musk weighed in and talked about the Supermicro role as well.
Yeah, and so remember, Musk launched XAI is kind of his answer to OpenAI and its chatbot, ChatGPT, and Musk then weighed in, to your point, Julie said, yeah, it's actually both Dell and Supermicro, and of course, investors have been looking at ways to play that sort of AI mega trend, and these are two ways they have piled into. Dell recently reported, said, hey, revenue from its AI servers growing strongly. Supermicro, as we talked about this week, recently announcing plans to expand facilities to bolster its AI business. So everybody is in on the party. Today, you can, we did see a pop and then now kind of fading that a bit. Of course, these two names have also had just historic runs as well.
Yeah, so is it, any kind of bigger change or just a little bit of a waning of enthusiasm on the day?
There you go.
Maybe the latter.
Well, coming up next, a conversation with Hewlett-Packard Enterprises CEO Antonio Neri about the company's new partnership with Nvidia.
And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, more market domination on the other side.
HPE Discovery is underway this week in Las Vegas. CEO Antonio Neri gave his keynote at the Sphere where he announced a new partnership with Nvidia. Antonio, thank you so much for joining us here on Yahoo Finance. Let's get started with this new partnership with Nvidia, who seem to be the gold standard of AI right now. Talk about that relationship and what you both hope to accomplish with this announcement.
Well, good morning, and thank you for having me. I hope you don't hear a lot of noise, but we have 15,000 people behind me at the show floor. This is 7 acres of innovation that we're displaying here in Las Vegas. But as you said, Jasmine, we hosted a keynote at the Sphere. It was a remarkable combination of story and AI. And there, Jensen joined me to announce the NVIDIA Computing Initiative by HPE. And the core of that, we really focus on the enterprise segment of the market, because when you think about AI, there is the model builders and the hyperscalers, you have the sovereign clouds and the enterprise. Obviously, we've already seen a tremendous traction on the model builder side and the hyperscalers, but we focus on enterprise. And at the core of that is how we deliver a simple AI solution to consume on premises. And we actually, for the first time in the history of the AI, we announced a turnkey, full co-engineered solution that at the core is a simple experience to deploy. It's 3 clicks and 24 seconds to have an AI model deploy in your enterprise. And that offer comes with NVIDIA Silicon, NVIDIA software, AI Enterprise, NIMs, and others, plus HPE infrastructure, both servers and storage, plus HPE software that complements that software from NVIDIA, and also security built at the core. So very excited. And Jensen and I believe this is going to accelerate the adoption in enterprise to drive the generative AI industrial revolution.
Antonio, on this partnership with Nvidia, I think a lot of investors want to know, when do you think, Antonio, this is going to have a positive, meaningful impact on your financials? I know it's early days, Antonio, but what can you tell investors? How are you thinking about that?
Well, Josh, it's already having an impact, because in my last earnings reports, I reported that more than 15% of our orders are already related to enterprise. And this announcement is going to accelerate the adoption in a much easier to consume way as a part of our HPE GreenLake Cloud offering. So we expect this to accelerate that adoption, and we hope over the next 2 to 3 quarters we start seeing the benefit of this. But remember, we already see enterprises adopting it, and we already see 15% plus already in our books.
Antonio, in your keynote, you emphasize that AI is hard and full of risks. We've seen plenty of that on the consumer and content side, specifically with accuracy. I'm curious, what kind of challenges are you facing in enterprise and hardware?
Well, actually, at the beginning of my keynote, I talked about the key ethical principles we need to guide ourselves and be the steward of. Those are simply as human focus, safety, security, which means IRO client security, and others. And we build those principles, Jasmine, in this offer. In fact, in this offer, the provenance of the model, the governance around the data that we put together. In fact, we built a data lake security model in the offer itself. And then also we put the guardrails. So the guardrails associated with the large language models come with this offer. My team and I worked on a fun thing to engage customers through the show floor. It's called Antonio Nearly, but he's an avatar of myself. You can go ask questions to him about anything. But what was amazing to me was the guardrail, so that Antonio doesn't hallucinate. And so the point is that we build all of those guardrails into the offer itself. And we believe this is going to help customers feel more comfortable around this. But ultimately, it's a data-first approach, and we need to make sure that we protect our data.
Antonio, I want to dig a little bit more into your AI servers, and 2 questions for you. One is the competitive landscape. Antonio, I'm interested in what you think makes your AI servers different and better than what Michael Dell is selling right now. And 2, Antonio, broadly, it does look like investors have questions about the margins of AI servers. It doesn't seem like everybody is necessarily increasing profits by selling them. Is that your situation?
Well, thank you for the question, Josh. Here, behind me, is one of the reasons why we're differentiated. There are people probably looking at the racks right now, and that's the direct liquid cooling capability. As you know, as we transition the roadmap from the current generation, which is the H100 to Grace Hopper and eventually Blackwell, Rubin, and Vera, Blackwell would require 100% direct liquid cooling. HPE has hundreds of patents in that specific space, and we have been doing direct liquid cooling for more than 2 decades. More than 2 decades. In fact, that system behind me is a supercomputing system. But ultimately, you also need to manufacture this. And so we have one of the largest water-cooled facilities here in the US and another one in Europe. So as we make that transition, HPE will be uniquely positioned to adopt this new technology with a higher power density. And that's why it's a huge differentiation. Second is the services capabilities. It's not about just selling servers. It's about deploying a generative AI solution and ultimately making sure that runs sustainably and consistently. And that's the other reason why our profitability is solid. If you go back to our Q2 results, we said we grew revenues in our AI servers by 18% year over year. And at the same time, we delivered a solid operating profit performance of 11%. And that's because it's not just the margins on servers, it's the margin associated with the software, and AI private cloud includes all the software, and also the fact that obviously we do all the services. And when you deploy this to GreenLake, actually we manage all that infrastructure on behalf of the customers, and therefore there is even more margins which are deferred over time. And that's why we are, I think, very unique position for what comes next, and be able to deliver solid operating profit performance.
And Antonio, yesterday a UK regulatory watchdog opened a probe into your potential $14 billion acquisition of Juniper Networks. Curious where that deal stands.
You know, Jasmine, I love the headlines. The probe actually is the standard regulatory process. Basically, we work with the regulator in the UK, and basically we work with them to file our approval for the transaction. It's standard process. In the UK, you have 60 days to go through that process, and the last day for the regulators to come back to us, we are very well engaged, is August 14th. So this is standard regulatory process, and we are very excited because that means we are in the timelines we announced at the transaction on January 9, and in that case we said that we are going to close this transaction end of this calendar year or beginning of calendar 2025. So very excited. This is good. This is actually really good.
Antonio, I'm just curious, how confident are you that Juniper really is going to create this meaningful tailwind for that networking business, that you can really replicate, Antonio, the success you had with other acquisitions like Aruba?
Yeah, I mean, first of all, from a shareholder perspective, this is going to provide twice the size of the current networking business, which obviously the flagship is HPE Aruba Networking. So think about it, we're going to have a business that's $11 billion, which will represent 35% of the company's revenue and more than 55% of the company's profit. So from an investor perspective, this is good because we are operating in margins that structurally are very different. From a customer relevance standpoint, this is super exciting because it will allow us to provide a true edge to exascale networking fabric. So as we go through this massive inflection point, which is basically the AI, the customers need a modern network architecture. Because today, even when you deploy AI, you have to manage 2 different networks. The one in the rack or in the AI server or in the AI system itself, and then you need to connect it to the data center. And therefore, there are 2 different levels of management, and that's complicated. So with Juniper and our networking IP, we'll be able to collapse that, and we're going to work with Jensen to integrate the 2 into the HPE GreenLake solution, and ultimately do it in an AI-driven way, because we already integrated generative AI in all our solutions, whether it's the networking management, whether it's the server deployment, or whether it's the storage management as well, and the capacity that we deploy for them. So super excited about that.
Antonio Neri, HPE CEO, thank you so much.
Thank you.
Now let's get to some trending tickers. First up, Gilead Sciences. The share's up 8% after announcing that its experimental twice-yearly medicine to prevent HIV demonstrated 100% efficacy for the investigation use in cisgender women in Africa, women and adolescent girls. So the company has some medications on the market already, but they either are daily oral or perhaps you have to do them as shots every 2 months. So this is less frequent. So the hope is that there will be more uptake of something like this, and it was shown to be quite effective here. So interesting development, and obviously the shares are reacting.
Yeah, I reached out to Brian Abrams over at RBC because he covers the name. Here's what he told his clients. He said this was, in his opinion, a much-needed pipeline win. He said more likely, though, still needs to break right for the company, particularly on the oncology side and elsewhere beyond HIV, to enable the stock to more materially re-rate. Said today's data, though, could be a solid start, though he remains neutral for now, target 74.
Yeah, I saw another estimate that this drug could bring in $1.7 billion or more in annual sales. It's interesting because it's not a vaccine per se, but it is still preventative. So a little bit of interesting how they sort of term this. And when you say a much needed pipeline here, the stock is down. Even with today's bump, it's down like 16% year to date.
Yeah, it's been rough. All right, moving on. Here's another one. Nikola shares tanking today after announcing a 1-for-30 reverse stock split that is set to go into effect after markets close on June 24th. This has been the theme, Julie. I feel like we've been hitting a few of these. I mean, the broader view, this is industry, obviously, as we've talked about. It's not growing like it used to, and stocks associated there have taken a hit. Nikola is no exception. I mean, manufacturers, those commercial EVs, that stock is down more than 50% this year. It's down about 70% over the past 12 months.
Yeah, I mean, this is one that has not really gotten off the ground. You recently had the news that Fisker had filed for bankruptcy, and Nikola has said in the past that there was doubt about its ability to continue being in business. So we'll see how much time this buys it.
Yep. All right, still to come. It is the latest edition of our series, Goodbye or Goodbye. Stay tuned. More market domination on the other side.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. And today we're looking at the most valuable public companies as they battle it out for the top market cap spot. I'm here with Theory Ventures founder Tomasz Tunguz. And interesting here, you're looking at these mega cap tech stocks. And let's get to your buy stock first. That is Microsoft. Now, Microsoft obviously has already had a big run, right? It's helped by all of this optimism about AI, but you think it's still a good buy. So let's get to why. First of all, you think that the potential in AI is even bigger.
It's enormous. I mean, Microsoft, if you look at it, is basically the leader in AI. They've developed a $5 billion run rate business in about 18 months. And because of their relationship with OpenAI, at least initially, and their significant investments in data centers, spending about $15 billion a quarter on CapEx just in the data center alone. And since we're just in the early days, really, I think the stock has a meaningful way to run. If you look at their relative share compared to Amazon and Google, they're actually winning share away from the other clouds. And then the last dynamic is 5 years ago, most startups really wanted, when they started to build their companies, they wanted to build on Amazon. And today, most companies are actually building on top of Microsoft because they want access to those AI features early.
On top of Azure, specifically.
On top of Azure.
Yeah, interesting. So enterprise AI is really then where they sit and where the strength is for a Microsoft, right? I mean, and obviously they have all those other relationships outside of Azure with all the other software that they provide as well.
That's right. I mean, you look at Microsoft, I mean, by far the largest software company in the world. The major motion that they're now pursuing is the ability to cross-sell. So if you're a software engineer and you want AI, Microsoft will sell it to you. If you want a laptop with AI, Microsoft will sell it to you. The other dynamic is they support many different AI families of models. So there's the OpenAI models, there's the Facebook Meta models, like the Llama models. They support all of them. They're developing their own models. And as a result of that broad penetration within the enterprise, they have access to lots of data that other people just don't have. And so they can train and they can infer and build new products. And that cross-sell motion, I think, will really lead them to build a pretty significant AI business. I mean, $5 billion in 18 months, growing 700% year over year. It's pretty amazing ability to create market cap.
And even with that growth, you say there's still a lot of room to grow because the AI stuff that they are now providing, not all customers are using it yet, or they're not using the full scope of the capabilities.
That's exactly right. So large numbers of customers, I think it's something like 80% of the Fortune 500 are now using AI, but the penetration is still really quite small. If you look at all the different products, Satya Nadella has done just a phenomenal job of prioritizing within each of the product lines, AI being the most important feature that they sell. And it's starting to gain significant penetration, but we're still really in early days. The impact of some of these businesses in terms of efficiency is absolutely massive. So Microsoft themselves is seeing a 50% improvement in developer productivity through their AI. ServiceNow is 75%. You saw Klarna announce a quarter ago that they cut 2/3 of their customer support team as a result of AI. So there's a lot of efficiency that Microsoft's AI in particular and their systems will bring to these very large companies, and they'll be able to reap disproportionate share.
So we always like to point out potential risks when we're talking about one of these goodbye cases. And in this case, it's maybe that, as you mentioned, the OpenAI partnership is now a strength, but maybe it won't last forever.
It won't last forever. I mean, you look at what OpenAI announced 2 weeks ago with the integration into Apple, you can see that OpenAI is looking to broaden out its distribution. And that's really important. OpenAI and Microsoft had a strategic relationship. Microsoft invested about $13 billion. And OpenAI was using a lot of the Azure chips in order to train and run the inference. Microsoft then decided to start to sell directly to their enterprises, competing a little bit with OpenAI. And then OpenAI is now pushing more in a consumer search direction. So I think you'll see OpenAI and Microsoft start to compete more and more, which will challenge that pretty key relationship. And there may be some headwinds there. I think that risk is mitigated by the fact that there's so many model families, so many different kinds of AI that Facebook and others are creating, that Microsoft should be able to diversify, but this is an important risk for sure.
Yeah, interesting to keep an eye on. All right, let's get to the stock that you're avoiding right now.
Yeah.
And this is, I gotta say, you might be in the minority on this one. We're talking about NVIDIA.
Totally contrarian.
Because, you know, most of the folks we talk to are big fans of NVIDIA, and they think it's gonna continue to grow. Obviously, the stock performance has been incredible. I mean, when it gained as much as it did last year, we said there's no way that can keep going, and it has. So, but you talk about the competition, which is something that is out there, certainly. A lot of folks have brought up this issue.
Right, so NVIDIA, unbelievable performance, right? You've seen revenue increase 5x. You've seen profits go from about $4 billion to $40 billion, $46 billion in 4 years. Really incredible business that's really driven by AI and the inference. when you have those profit margins like 60%, you're going to face a lot of competition. And it's not like, Google has been developing their own TPU chips. Amazon has both training and inference chips. AMD just announced a chip that is 30% more powerful than the current Nvidia H100, which is the dominant inference chip. And so there will be significantly more competition here. And if you look at Nvidia's profitability growth, it's basically just a doubling or a tripling in prices in terms of the GPUs. And as more competition comes in, as the CapEx spend increases pretty materially on the development of these chips, I think those profit margins ultimately shrink.
Interesting. Okay, and let's also talk about valuation, because that's a part of the story. So if you look at the PE that we have seen, and this is the forward PE, this is going back 5 years, I believe, on this forward PE, and you have seen sort of spikes in the PE, and then it's come back down, right? So what is that? I mean, we're not quite at the spike yet here, and in fact, a lot of the people we talk to say, actually, the valuation hasn't gone up that much, but how are you thinking about the waves that we have seen?
So NVIDIA, if you look at the stock over a 15-year basis, has seen 3 major waves. The first wave was around gaming in the 2010, 2012 timeframe. The second wave was driven by crypto in sort of the 2018, 2020 wave.
Right, before.
And now we're sort of in the AI wave.
Yeah.
And at each point in those waves, the PE has gone above 50, and then 6 to 8 quarters later has fallen to 25. So the counter-argument would be, well, this wave will run a lot longer because, the NVIDIA team has said at least through the end of next year, there's plenty of demand for GPUs that outstrips supply. But over time, the reality is like, this is a company that's selling chips, and these kinds of multiples are, I think, really difficult to sustain over the long term.
Right, it's quite unusual. So they need to look into software, and they already have, right? They're selling sort of this suite, including the chips, including the whole, the rack as part of the whole selling point, and the software. But you think they need to get more into software?
I think they absolutely need to get more into software. I mean, you think about the multiples that software companies have, they typically trade as a function of revenue, particularly the high growth ones. And I'd put NVIDIA, if you were to think about it as a software company, would probably trade at somewhere between 12 to 18 times top quartile, maybe even a little higher just because of the dynamics around AI and how special they are. But the reality is the fraction of revenue today that's in software is not disclosed, and it's probably still quite small. So as the demand for GPUs attenuates with time, they will need software to meaningfully boost up their multiple, particularly because the growth rates of the data center business will plateau. Today you're seeing Microsoft and Google and Amazon spend about $12 to $15 billion in the data center a quarter. Over time, that will sort of decrease, and so the growth rate in the data center part of the business, which today is about 60% of the revenue and by far the fastest growing compared to gaming and automotive, will slow. And so software will absolutely be the key.
Very interesting. Okay, so let's get to what, though, could go right for NVIDIA. And that's just that, you know, there is this promise of competition, but it might not come for a while.
That's right. So I'm a long-term investor, so I'm thinking about 3 to 5 years. In terms of how people actually compete with NVIDIA, you need to produce chips, right? And within the US, our ability to fabricate chips is pretty limited because we've outsourced that through the whole fabless wave in the 80s and 90s. And it will take a long time to get these fabrication manufacturing facilities up and running. And the time to ship some of these chips is a lot longer. It's just in software, right?
Yeah.
There's tape out, you have to actually produce it, there's yield management, there are all kinds of supply chains. And so it may take longer than, and particularly, I mean, you look at Facebook will spend alone $20 billion this year buying GPUs.
Right.
Amazon and Google, who are building their own chips, they may not be able to ramp production that quickly or even satisfy any of that demand. In fact, Microsoft, right in the last quarterly release, said that they're unable to satisfy the demand.
So, yeah. So, okay, well, we'll see what happens with NVIDIA. Real quickly, before we let you go, what are your positions in each of these stocks?
So I hold, Microsoft is my single largest public position. NVIDIA is a very, very small position.
Gotcha. Okay, Tomasz, thanks so much. Really appreciate it. Interesting stuff and a little bit of contrarian take on NVIDIA. Appreciate it. Thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
All right, let's get to our call of the day now. Piper Sandler naming AMD, its top pick in the large cap space. So this is Piper's Harsh Kumar decides Lisa Su's company is a top pick in the large cap space heading into the second half of the year. Apparently, Julie, he met with the management team, says he walked away extremely impressed with the strategy as well as the competitive positioning. We feel there are additional tailwinds, he says, set to come for both the server and PC businesses. Says AMD looks to have bright prospects moving into the back half.
Yeah, so bright that he boosted that price target to 175, although it's not that far from 175 now, especially after this gain that we're seeing on the back of this analyst call. A couple of things that he talks about. He says that the company in the first half of this year had been constrained with the delivery of its accelerators, its AI accelerators, because of supply issues, but he thinks that will alleviate. He also expects them to take share from Intel in the server market, which is quite interesting. He says AMD will take 5 to 6% of share from Intel this year. And their share of the server market is already about 33%. So those are a couple of the reasons behind that call for Harsh.
And in valuation, no surprise, thinks that looks pretty attractive here. Says we like AMD's valuation here relative to peers in the compute space. So continues with an overweight. Yeah. All right, moving on. Wedbush Securities initiating coverage of the trade desk with an outperform rating. The firm highlighting top-line growth potential in digital advertising spend is expected to rise in 2024. And here to discuss that call is Scott Devitt, Wedbush Securities Managing Director. Scott, it is always good to see you on the program. So let's get to this call, Scott. So you're a fan of the trade desk. You initiate coverage with an outperform. Your target, 110. How come, Scott? Walk us through the argument.
Well, the drivers for trade desk really are this transition that's happening in the advertising industry, where connected TV is shifting from linear to streaming TV, and the advertising is following. And the trade desk is a big beneficiary. Almost half of the business is video today. Our expectation is over the next 3 to 5 years, you're going to see an acceleration in the decline of linear TV, which will be a significant tailwind for the business. In addition to that, retail media is becoming an increasing portion of the online advertising industry, and Trade Desk has a quite innovative model where they're pulling in first-party data from retailers to further inform their demand-side platform for advertisers. Both of those drivers, the two most significant drivers for the ad industry, which is what is so interesting about Trade Desk.
Scott, it's zoom out a little bit, because as we talk about the continuing transition from cable TV, traditional TV, the way that advertising works there, and then connected TV and how ads are sold onto those platforms, what's the biggest way that has shifted? And are any of those sort of older players playing a role in this new ecosystem, or is it sort of Trade Desk's, market to take?
Well, Trade Desk is the leading independent demand-side platform. The largest competitors actually are probably Google, Yahoo's still in that business, Microsoft, and Amazon has a growing DSP business as well. But what's happened over the past, 10 to 15 years has been this transition from guessing with advertising to increasingly having real-time programmatic advertising, where advertisers are bidding and content owners are pricing inventory properly and meeting in an online exchange. And that, to us, is going to increase as a proportion of the overall industry going forward. And Trade Desk is the leading provider of that. In addition, these companies that Trade Desk is competing with are companies that are under regulatory scrutiny. So you always have the possibility as well that there could be divestitures that are forced, say with an Alphabet, where the government forces the company to unbundle its ad tech platform, which would be a significant positive for Trade Desk if that ever happened.
And Scott, you look at Trade Desk, stocks enjoyed a nice run. I mean, it's up about 35% already this year, but you must think valuation still attractive here, Scott.
It's high. It's similar to history, but I wouldn't call it a bargain at current prices. The company that I think is probably the most comparable to Trade Desk, interestingly, many don't think of it this way, is Shopify, which provides a similar service on the e-commerce side. And when you look at Trade Desk relative to a Shopify, it's faster growth, it's a significantly higher margin business, and it trades, Shopify trades about a 30% premium. So on a relative basis, relative to the company that we think is probably the closest comparable, it trades at a meaningful discount. On an absolute basis, you can see our target price is only about 12% above the stock. I wouldn't call it a bargain, but this is an emerging blue chip company that you want to own.
And Scott, we're just coming off of Cannes, and a lot of advertising and marketing people gathering there. Was there anything you heard coming out of that conference that also, informs how you're viewing Trade Desk and some of its competitors in terms of how ad dollars are going to be flowing?
A lot of conversations and relationships announced using retail media data, and that there was an announcement with Amazon. There was something with Instacart, and so what you're finding is these data repositories of media content are now being brought to life, and that's going to continue to enhance the advertising models as these retail companies, some of which do it directly, like Amazon, providing their own demand side platform for their retail media inventory to third-party advertisers. And many retailers that don't have the capacity to do that, like Walmart, that are actually partnering with companies like Trade Desk to provide that service for them.
Scott, I know you cover and you like Amazon, Alphabet, and Meta. You got outperforms, I think, on all three. If I asked you, Scott, though, to pick one, would you give one name there that you think you'd be most bullish on right here at these levels?
Amazon. Amazon stands out. The retail, business is going through this renaissance period post-COVID, where revenue growth is accelerated again and beginning to stabilize at traditional levels. Margins expanding. The online advertising business is approaching $60 billion and growing twice the rate of the overall ad industry online. And the web services business is making a recovery where you're comping some of the reduction in activity from last year. And so AWS throughout the remainder of this year will accelerate as well. So among those four, we like them all, but I would rank Amazon number one.
Scott Devitt, always good to see you. Thanks a lot for taking the time to chat with us.
Thank you.
So look, mortgage rates falling for the third straight week. We'll speak to the CEO of the National Association of Home Builders on the other side about the latest housing hurdles. New mortgage rate data coming out today showing a decline for the third consecutive week to 6.87%. This as we also got numbers on housing starts and building permits, both of them slumping unexpectedly. In particular, starts falling to the slowest pace in 4 years. Our next guest says those mortgage rates are one thing holding back both housing supply and demand. We're bringing in Jim Tobin, CEO of the National Association of Home Builders. Thanks so much for being here. So obviously there's a lot of interconnectedness when we're talking about what's going on with rates, what's going on with builders and the activity that they're doing based on the demand that they're seeing. So when you see that number, the slowest pace in 4 years, do you lay the blame squarely at the foot of mortgage rates?
Yeah, I think it's two factors. One is mortgage rates. People see that, early in this year, we saw mortgage rates fall. People started to get optimistic, especially ahead of the spring and summer buying season. And then rates started to creep back up. And now we're at 7 just a month ago. We're a little bit lower now. It's great to see that they're starting to fall a little bit, but that's mortgage rates really suppressing the demand in the buyer market. The other side is capital to build more homes. Our members use something called AD&C financing, acquisition, development, and construction loans. We're seeing that those interest rates are running between 10 and 13%. So that's really suppressing that capital that the private builders need to start planning for that new construction.
And Jim, the 30-year fix, I'm just looking at Mortgage News Daily, we're sitting here at 7.02%. I mean, you've got smart economists on staff. I mean, as they try to gauge where that's going 6 months from now, 12 months from now, what do they see?
We're optimistic. We think by the end of the year, we're fully in the 6% range for mortgage rates. It's really going to take more signals from the Fed that they are in fact going to cut rates. We think that's going to happen maybe certainly once at the end of the year. Maybe we get a second one. But we're looking to be in the high 6s by the end of this year, and then when we get into 2025, we can further retreat into the 6s. But it's not until 2026 where we're really into the 5%.
Does high 6s, does that spur traffic?
I don't think high 6s does. Yeah. I think low 6s does, and then really when we flip over into the 5, I think that's where you're going to see demand, especially in the existing market, where that's going to really open back up, and that's what we need.
Jim, why aren't people getting used to rates at these levels? I mean, we've had the discussion before. I mean, historically, these rates are not that high, right? And so why isn't there a process by which buyers are just saying, okay, this is what it is, I got to move anyway, and that process start to begin? It doesn't seem to be happening.
If you have to move, whether it's for a life-changing event or a job that you can't pass up, sure, you're gonna take on a 7% mortgage rate. But if you don't have to, you're not going to move, which means you're more likely to probably remodel your existing home in the short term. I think we have a whole generation of buyers who think 3 and 4% are normal, and it's going to take a little bit of time before they recognize that rates are going to settle into that 6 or 5.5%. And until then, they're always going to feel like they're going to fall backwards. So why jump in now? Because maybe 6 months from now, or maybe a year from now, they're going to be better. It's the old adage of you date the rate and you marry the home. Whether people are willing to refi in a couple of years remains to be seen.
So just to go back to what you said then, you think 5.5%, 6% is sort of the steady state here?
I do. I think that's where we are. Again, it's probably in 2026 when we finally realize that, but that's where we think the new normal sets in.
And Jim, you have your own sentiment index. I mean, how are builders feeling?
Builders are feeling pessimistic. We had gains all the way through the first half of this year. We've lost all of them. We're now below the 50-point mark, which is our barometer. Anything higher than that is positive. Interestingly, we had 1,000 builders in Washington, D.C. last week for our spring conference and legislative conference. They're actually in a really good mood, surprisingly, because they're the only game in town. Month to month, new homes usually make up about 10 to 12% of the market. We're now about 30 to 35% of the market. We're the only game in town because that existing stock is so locked down. So they're buoyed. Sure, they're building fewer than they did a couple of years ago, but they're in a steady pace. They're selling homes, but they're working harder to get people into home ownership, meaning they're rolling prices, or they're looking for incentives like buying rates down to keep people moving into homes.
I'm also curious about the supply side of the equation in terms of their supply chain, not just with stuff, but with labor.
Right.
What's going on with costs on that end?
Labor's still constricted. Month after month for better part of a decade, there's 400,000 openings in the construction labor market. That continues to keep it tight. That's why we invest so much time and effort into training the next generation of skilled contractors out there, why we need immigration reform.
When you go to Capitol Hill, Jimmy, you talk to a lot lawmakers about immigration policy?
That was our number one issue this year, was about workforce development and immigration, which is so politicized right now. And it won't be until whoever find out who the next president is where we can really tackle the issue. But we have got to solve the immigration problem, from the border security all the way to what do we do with the undocumented.
So what's your priority then? What would what would an ideal, forget about what's going on in Washington on the political side, but what would an ideal situation look like for you guys?
Immigration reform-wise?
Yes.
Yeah, so secure the border. We want people who want to come into this country legally to come through in an orderly fashion. We want people who want to work in the construction industry to have a visa that allows them to work in our industry, just like they can work in the seasonal market or they can work in agriculture. And then we've got to figure out how we can have, as employers, how we can be responsible as well to make sure that people that are working on our job sites are work eligible. That is critical to the functioning of this. And then, of course, we have to figure out what we're going to do with the undocumented and what's the realistic goal there about bringing them out of the shadows and putting those people into the economy.
I'm sorry, just what percentage of the construction workforce do you think is undocumented?
I don't know about undocumented, but I can tell you from the immigration perspective, about 23% of the construction industry at large, not just home building, is immigrant labor. So it's a critical component of our workforce.
Right.
When you talk to those builders, Jim, I'm just curious, have their sort of business models evolved? Can they build more quickly than they used to?
No, they're building slower. In fact, the average time.
Why is that?
It's land entitlement processes, number one. Number two, the permitting processes, the fees that go along with it, construction material delays.
So red tape and regulation have actually gotten worse.
It's absolutely worse. In fact, regulation at all three levels of government add about almost 24% to the cost of a home, $93,000 in total. Multifamily, it's even worse. Almost 43% of a multifamily unit is tied up in regulatory burdens and costs.
What about innovation, though, when it comes to building?
Well, I think you're starting to see panelization, kind of building those wall structures and trusses off-site and bringing them in. That helps with our labor force as well. If you're not doing complete stick built, then you can have fewer people on the job site. You need people to put those walls together. So that's an innovation that it's taken off a little bit, but we haven't fully realized that yet. It's a chicken and egg issue. People need to invest in those factories, but we need uptake in the marketplace as well. But that's really where I think AI is starting to play a role in managing your supply chain, things like that. So we're still evolving. We still tend to build our homes stick built, and that's the way people that's the way people like it.
Jim, great to see you. Thanks for coming on the set.
Thanks for having me.
Appreciate it.
Thanks.
All right, well, we are wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day. Still seeing a mixed picture here with the Dow up about 300 points. That's about 0.75%. The S&P 500 down about 0.25%, and the Nasdaq leading declines off by 0.8%. Now, lately, the past few days, I've been checking on this sort of broadening thesis, right? That things are going to broaden beyond tech. Well, today, that's actually sort of happening. That's S&P equal weight index outperforming the S&P 500, and that's because you see that underperformance of tech today taking a little bit of a hit, and then a more broad gain overall. Energy, by the way, also a part of that upward movement that we are seeing. Something else that I know Jared Blickery is going to be watching very closely as well is what's going on volatility and volume-wise today and tomorrow. We've got index rebalancing, we've got witching, that is expiration of futures and options contracts. So, will we see more of an uptick in the VIX? Maybe. We'll definitely see more volume when it comes to people changing positioning ahead of all of those other changes, Jared.
Yeah, glad you mentioned that, Julie. Something like $5 trillion in notional options going to expire tomorrow. Plus, we have S&P rebalancing. Remember that whole issue with XLK? That's tomorrow, so stay tuned for that. As you said, Julie, the Dow is up today and the Nasdaq is down. It's been the flip of that for I don't know how many days, but we're seeing the Dow get its light in the sun today. And let's check in on the sector action where we see energy. That is the number one spot, up over 1%, actually closer to 2%, followed by utilities and financials, then communication services, healthcare, materials. That rounds out the top row. And then tech, the biggest loser to the downside. And in what I'm calling the chip-pocalypse, well, is it a disaster? No. Nvidia is down 4%, but we haven't seen a really red day like this in the semiconductors in some time. So I'm going to get into that with Josh in about 30 minutes. And speaking of Josh, back to you.
Jared, thank you. Looking forward to it. Shares of Nvidia seeing a sell-off midday, leading to the tech giant's declines today. Our next guest today sees a big concern with Nvidia and its customers. For more, let's welcome in Tim Pagliara, CapWealth Chief Investment Officer. Tim, it is good to see you. So maybe we'll start there, Tim, with Nvidia. Investors have piled in. Tim, the street loves this name. I mean, nearly 90% of analysts who cover Nvidia say you should buy it, even here. But you're cautious about Nvidia. How come?
Well, for the very reason that there's so much consensus. I think it was in a 10-day period, Nvidia added more market cap than Warren Buffett created in Berkshire Hathaway in 60 years. So that has to give everybody a little bit of pause about, where things are headed. I was asked in an interview yesterday about which tech company will hit the $4 trillion mark first. And I said, well, I think you got to break that into two parts. Which one will hit first, and then which one's going to be sustainable at a $4 trillion company. And I chose Microsoft, but I think Nvidia will probably at this point hit first, just because of the fervor and consensus that everybody thinks that you've got to own that to be successful long term.
Tim, it's Julie here. When you look at Nvidia, what is your extrapolation to the rest of the market? In other words, is what's going on with Nvidia a risk sign for the rest of the market, or do you think that it's just sort of specific to it?
I think it's a little bit of both, but I think for the value investors, the people that look in places where no one else is looking, I think it's a great opportunity because you have Nvidia, the market cap of it exceeds energy, it exceeds utilities, it exceeds the value of GE. The last time we went through something like this was in 1998, 1999. Ironically, the darling of that era was Coca-Cola. It had been on an 18% per year compounding, 21% annual increases in dividends. And you could have taken a dozen companies and you could have owned those, or you could have owned Coca-Cola. It's the same thing with Nvidia right now. You can own the entire energy complex, the entire utility complex, General Electric, or you could own Nvidia. You could have 15 Intels, I think is the number, or maybe a little bit more, or you can own Nvidia. So how sustainable that is ultimately with long-term earnings and profits given the inherent nature of the chip industry, it's not a good bet from my standpoint, long term, in my experience.
So Tim, what would be, in your opinion, a better bet, a smarter bet right now? Give us some ideas of where you would be more comfortable committing capital.
Well, I think it's, when you look at artificial intelligence, we look at kind of a picks and shovel type of approach, like in a gold rush, sell the shovels, sell the picks. In this instance, it's the electricity, complex. I mean, no one really talks about it, but, a Google search today compared to a Google search with AI takes 10 to 15 times as much energy. And that hasn't really hit the market yet. And so I see energy companies, GE, Vernova as an example, as really benefiting from that. So you can make money around the edges, I think, in a more sustainable long-term way, because our utility industry, our grid, all of that needed upgrading anyway, and this is just going to accelerate the need for that.
A lot of those stocks have been bid up as well this year, and their valuations, one could say, are getting stretched too. But you think there's more upside for the utilities and some of the other sort of infrastructure providers?
Selectively, on a valuation basis, they still look, much cheaper and more sustainable long term. I mean, the building out, an energy complex, building the grid, that's probably a 15, 20-year process at this point. So I think there's a really long runway. Intel, for example, if you look 3 years out, 5 years out, when they get their CapEx starting to churn out revenue, they've got a very, very bright future. They already have a chip that they claim is going to be faster than Nvidia's. There's not, and again, I'm just trying to put a cautionary tale and some reasons where investors should be cautious, because this is where people lose a lot of money. You guys have talked about it. People have been around a long time. Look at Cisco. Cisco had the largest market cap of any company in the world. When these things turn, it's a long recovery. People forget it took 13 years for Microsoft following the peak in 2000 just to get back to where it was. That's a long time for investors that are used to making money every day.
Yeah, good reminder, Tim. Thanks a lot. Appreciate it.
You're welcome.
Still to come, the latest election poll from the Morning Consult shows 1 in 5 Americans are double haters, viewing both Biden and Trump unfavorably. But one of them has got to win, right? We'll discuss when Market Domination Overtime returns. U.S. casino operator Boyd Gaming has reportedly approached Penn Entertainment to express interest in acquiring the company. This, according to Reuters. Any merger would be one of the biggest since Eldorado Resort's $17.3 billion acquisition of Caesars back in 2020. The report also mentions there is no certainty that Penn will engage in those negotiations with Boyd, but the news did move Penn's stock prior to the close today, and it finished up by almost 10%.
And a week from tonight, President Joe Biden and former President Donald Trump will meet for the first presidential debate. So what does current polling say about their chances? Here with more is Yahoo Finance's very own Rick Newman. Rick,
hi guys.
What does it say?
Well, what caught my interest this morning was this the latest update from Morning Consult, which does very detailed ongoing polling. They looked at the double haters. So if you're not familiar with this phrase, the double hater, get familiar with it. You might even be a double hater. So double haters are the people who dislike both Biden and Trump. And Morning Consult says that is about 17% of all voters are so-called double haters. So what are they going to do? I mean, and let's keep in mind, the margin of victory in the Electoral College in 2020 was less than 1% in 3 swing states. Tiny percentages really matter here. So of these 70% of voters who say they are double haters, they don't describe themselves that way, they just say they don't like. But Biden has now taken a lead among the double haters, and that is new. Trump had a lead among them, and Trump won the double haters. There were double haters in 2020 as well, and Trump won them by 17 points. So Morning Consult says Biden is now ahead among this group by 29% to 25%. 34% of the double haters say they will vote for another candidate, so think RFK Jr., and 12% of them say they don't know what they're going to do. You think 12% of 17% is not that big. That is very big. 12% of 17% is a very big number when you're fighting for every vote in swing districts in 6 swing states. So, I mean, this gives you just an idea of what's going to decide this election at the end of the race. I mean, we've got all kinds of polling now, but this is who it's going to come down to: is these voters who don't like either candidate, and some of them haven't made up their minds yet.
Well, and then the question is, what will help them make up their minds, right? Will it be, for example, the debate? You have to wonder how much of these double haters are going to hold their nose and sit through the debate.
It could be quite a lot, actually. I mean, presidential debates get a huge audience. Not in the primary elections. Those are kind of snoozers, and by the way, those tend to happen way before the actual election. But I mean, we've had high 8-digit viewership for presidential debates. I feel like 70 million people watched the presidential debates in 2020. My number could be off, but it's expected to be very high this year. And debates can make a difference. So we've got 2 debates scheduled so far. One's coming up next week, and the other one is not until September. So that September one will probably be more decisive. But debates have historically had some defining moments. I mean, Ronald Reagan in 1980, at the close of the final debate with Jimmy Carter, he said, "I want to ask the audience, are you better off now than you were 4 years ago?" That has now become kind of a characteristic phrase in the economy. Ronald Reagan had no other. There you go again. And there, I mean, some of these debate lines become famous, and they really can form an impression. And so with Trump and Biden, I mean, I'm going to say what's on everybody's mind, which is which one of these guys is going to have a senior moment in front of a national primetime TV audience. If one of them does, that could be the thing that's decisive. If neither of them does, voters might start to feel a little bit better about their choices. Maybe we'll have fewer double haters. But my guess is the double haters are going to remain.
Double haters. It sounds like a punk band that I didn't know I needed.
Well, we were just saying, are there any triple haters out there? There have to be, right? I mean,
I would think so. I was trying to think if there are any famous lines from more recent debates. The only one that popped to my mind was, "You're likable enough," which was not decisive in the election.
So Barack Obama did very poorly in one of the debates in 2012 against Mitt Romney. And Mitt Romney's poll ratings went up, and all the Biden team said, "Wow, we got to regain that ground." So Biden, he studied up. He had a much more robust performance in the final debate, and he got over the finish line. But that was a worrisome moment for the incumbent back then.
All right, well, we'll see. Thanks a lot,
Bye,
Rick.
guys.
All right, MicroStrategy diving in further with Bitcoin with plans to buy $786 million more in the cryptocurrency. And while Bitcoin has reaped the benefits from the launch this year of spot Bitcoin ETFs, crypto investors are already eyeing the next milestone for the market with the spot Ethereum ETFs. They're expected to be perhaps approved this summer. Here to discuss this and more, Swan Bitcoin Chief Investment Officer Raphael Zaguri. A pile on top of all of this, we were just talking about politics. There has been a flurry of lobbying activity in Washington when it comes to the crypto industry. All of that said, we have not seen much fireworks on the price action front lately, Raphael. So what should investors be looking for there?
Yeah, thanks for having me, Julie. Great to be here. I think, first of all, when we talk about the double haters, as I was just listening to the topic, I think crypto is becoming one topic that may sway a lot of the double haters. I think a lot of people, unfortunately, are very, losing a lot of trust in the system along the last few decades. And when you have a team like that and we have politicians jumping one side, maybe they will move some double haters. But going back to the price, which is what you mentioned, Bitcoin price has been very stable. I think in the if you look in the last month or so, this is nothing new. This has happened in the past. If you actually look at Bitcoin price, the way that it moves, it tends to be most of the times, it's sideways or down. And then most of the upside is actually captured in very short periods of time, right? And I always say that this is why it's an asset that it's very hard to hold in the longer term, because most of the times they're going to be enduring pain. It's weeks and months of pain, for days of glory. That's the typical trajectory of Bitcoin. Going back to the numbers, if you look where we are right now, in terms of volatility is fairly low. We're at the 5%, I would say, bottom decile in volatility times. And I think the good news, if the past is any guidance of what could happen in the future, is that periods of very low volatility in Bitcoin tend to have offside periods of return if you look 60, 90 days ahead, right? But short term, a lot of things can happen. In the short term, traders control the price. And I think it's always more important for us to zoom out, go back to the fundamentals, and then think about where Bitcoin could be, not in 90 days, 60 days, but 5, 10 years from now. Because as an asset, that's what we should be thinking about for Bitcoin.
I'm interested, Raphael, too, when you talk to friends and family and they ask you why you would own crypto here, I'm interested, what are the reasons you tell them? Because I do feel like maybe the story has shifted. It used to be, I think, so idealistic, Raphael. At least among the true believers, it was really thought of as this paradigm shift. I'm wondering if you think that's still the case, or do you tell them it's a store of value, it's a medium of exchange? What are the reasons?
Yeah, Josh, I come from the traditional finance system. I worked at Goldman, I worked at Merrill, I worked at Deutsche Bank, I worked at all the big banks. And for many years, I tried to tell people about Bitcoin, and most of them just shied away. And I think a lot of it, because people start, as you mentioned, a lot of them start as a mini of exchange as their first, they try to put Bitcoin alongside PayPal and other things and other technologies. But Bitcoin is much bigger than that in my perspective. I think Bitcoin is the best savings technology that we've ever seen. As an economist, when I look at Bitcoin and, a monetary policy that it's written in code, it's transparent, it's fully predictable, 15 years without any changes, right? There is not a single central bank in the world that has a monetary policy that it's anywhere close or similar to what we've seen in Bitcoin. And at the end of the day, when we talk about inflation and predictability, what really kills, the plans of economic actors is volatility and inflation. If we had a 2%, which is the target inflation of the central banks, which by definition is already very bad. But let's say they were able to hit 2% every single month or every single year without any changes, that would be bad already. But that's not what happens. There's huge volatility. Some months, inflation for the things that you buy may be closer to 10%. Other months may be negative. And planning around that, it takes a toll and has a toll on the economy. And longer term, not only that, right? The money printing continues, things continue to be debased. And, if you look at a world of full unpredictability, just what we have, and unpredictability increasing, Bitcoin, I think it's a beacon of predictability, in a world where you can't predict anything pretty much.
I don't think if you look at a price chart of Bitcoin, you would say it's a beacon of predictability. And 2% inflation means growth. So with growth comes inflation. Usually that's the way economics works. Although, yes, we've had very low inflation before this current regime. But leaving that aside for a minute, Rafael, I want to get back to something you mentioned in the beginning when we were talking about politics and talking about the focus that those in the crypto community have sort of zeroed in on this election. What are you looking for in terms of the biggest policy change that you would advocate for that would help the crypto industry?
Yeah, I think we're already seeing. If I said, in the past, if I told people that Bitcoin would become a topic of discussions among, presidential debates, people would say it was crazy, that it would, and they did, that this would never happen, that, this was something that could never happen, and it's happening. It started, with senators talking about Bitcoin, then we had, more people talking about it, and now we have Trump coming in, and which was a surprise for most people, even, for some of us that have been in Bitcoin for a long time, to hear him saying, the positive things that he did. And as I said in the beginning, I think for people that are very disillusioned with a lot of things that are happening in politics, this could be, a very substantial change. On top of all of that, if you just look, the ETFs being approved, I think started with a lot of these things, and the whole process of getting the Bitcoin ETF approved, that was also, I think, a path was hard to go through. But the bottom line of all of this is that we're getting a lot of things that we've been looking for a long time, which is getting more support, more clarity around how you should hold Bitcoin, how you can wrap it, and that's all positive. I think at the end of the day, even when we talk about an Ethereum ETF, I think all the ETFs, they should be approved. And what the SEC should be focusing more and more is what it was supposed to be focusing, I think, from the beginning, which is what they started when we had the Securities Act of 33 and 34. The whole goal was to provide better transparency, better disclosure, prospectors that really highlighted the risks. And I think that there's an opportunity here for the SEC to turn back to their original mandate and to help with that. But overall, it's just very good and very positive to see the developments. I think, definitely heading in the right direction.
Rafael, great to see you. Thanks for making time for us. Appreciate it.
Thank you.
And time now for To Watch Friday, June 21st. We're going to start off with housing. New existing home sales numbers for May coming out in the morning. That number expected to decline compared to April. This is coming after new housing starts data from today hit the slowest pace in 4 years. The new home sales data giving us more insight into home buyers as they continue to get squeezed by sticky inflation and mortgage rates.
Taking a look at the economy, new purchasing managers index data coming out in the morning as well. Economists forecasting those numbers will tick down slightly, and this coming after U.S. business activity accelerated at the fastest pace in 2 years last month, giving us another key indicator of economic activity.
And finally, CarMax set to report its first quarter results ahead of the open tomorrow. Analysts expecting the used vehicle retailers' profit and volume and sales to remain strong. Companies knocking on the door now of rival Carvana, but still trails in gross profit per unit.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, going to be breaking down the trends of today that'll move stocks tomorrow. Here's some of the trends we're going to be diving into. The S&P 500 pulled back today after briefly passing 5,500 for the first time ever. Blame sliding tech stocks for the lost traction, though the broader index still on track here for gains in this holiday-shortened week of trading. Plus, as big tech names scramble to cash in on the AI craze, where do startups fit into the hype? We're going to speak with one early-stage investor about trends within venture capital. And healthcare is one of the sectors getting a piece of that AI funding pie thanks to new initiatives from Amazon Web Services. We're going to be taking a closer look at the problem AI is setting out to fix on our latest edition of Lead This Way. Now, if recent earnings are any indication, all it takes to drive investor enthusiasm is AI. But for smaller startups, it's a competitive landscape out there, especially in technology. So what are the venture investors looking for? With me now is Headline Venture Partner Cameron Ansari. Cameron, great to see you as always, my friend.
Good to see you. Thank you.
I thought we were talking, Cameron, off camera. I thought we'd start with your kind of job. Listen, you're meeting a lot of interesting, smart founders and entrepreneurs. And I want to start with just what interests you right now. In terms of just broad topics and trends, is it just AI 24/7 right now, Cameron? Is that it?
I mean, I was joking with somebody, if you add .ai to the end of your URL, then it increases your valuation
right.
by 2x. So, there's a lot of, obviously, theater right now with everyone saying that they're leveraging AI, I have AI. What's your AI strategy? But to me, AI is a foundational layer. It's kind of like saying I'm a mobile app, or I use the internet. It's like HTML or one of these foundational layers.
So how do you, it's a really interesting point you make. Then, Cameron, how do you sort of, as an investor, how do you kind of distinguish, okay, this is real versus I'm hearing marketing fluff?
Right. So I think that there are legitimate use cases for AI where it's additive. I've spent a lot of time in fintech. Within fintech, for example, there are 3 or 4 broad use cases that people have identified, and I think makes sense to me, where AI can really be a differentiator. For example, customer service. Klarna recently announced, Klarna is the giant, buy now, pay later product in Europe and in the US a little bit as well. They replaced something like 900 customer service agents with an AI solution that actually got a higher score in terms of satisfaction from customers. So customer service is one area. Another is underwriting, for example, lending and insurance. Another is with thinking about how AI can be leveraged for things like the back office and improving your internal operations. These things all make sense. There are other things that you can say you have AI within your banking app or whatever, where it's like, okay, that's nice and all, but is that really necessary, or is that going to improve the customer experience? And then you have to differentiate between where it can actually add value and where it's just a bit of kind of extra dressing.
I'm also interested, as you sort of decide, okay, who you're going to write a check to. You meet a lot of smart people. What are the variables that decide that?
It ultimately comes down to the founder. Honestly, no matter, people would say at the
just
founder
their experience,
matters,
their background.
The experience, the background, the personality, right? The stick-to-itiveness. I think the thing you're trying to suss out is this person, in my opinion, what I call a figure-outer. The best founders are figure-outers. They're the kind of people that are going to hit stumbling blocks because those are inevitable, right? Every startup, every company, whether it's seed stage, whether it's Series D or E or a public company, runs into problems. You're going to have problems with people, with funding, with strategy, with competitors. And the best founders are the ones that figure out a way forward. They don't get discouraged. They're always trying to move ahead and can pivot and move quickly. And that ultimately is kind of a DNA thing, right? I think you either have it or you don't. And that's the thing you really try to suss out as you're meeting a founder and getting to know them and figuring out.
So founder.
I think so. That makes so much difference in the world. You have the best product in the world, the best company, but if the founder, because the founder ultimately is the person that they hire, they recruit, they fundraise, they market, they have to get out and talk about the company. And if they can't do those things well, then the business is ultimately not going to succeed.
There's a lot of people listening right now. They may not be invested in private companies, but they're invested in publicly traded companies. Right? And so I was interested to get your take on the broader IPO landscape. Are you surprised that maybe that we haven't seen more companies taking the public market plunge? In the sense that, Cameron, the stock market's working, the economy's decent, inflation's moderating. What do you think?
It could be a matter of time, but at the same, in the same breath, I'm looking at the performance of the companies that have gone public since September, and you have.
What do you make of it?
It's been mixed, frankly. When you look at the actual, I was running the numbers recently.
Is that part of the problem then?
Exactly. It's like other than, in fact, the 2 best performing stocks that I saw. One was ARM, which was obviously a blockbuster IPO. The other is Cava, the food business, the Mediterranean chain. So the other ones, Instacart, Klaviyo, Rubrik, Ibotta, they're in many cases flat or down from the IPO price. So none of the other tech names that have gone public other than ARM have really done tremendously well in the public market. I think Reddit's up like 15, 20%, which is one of the exceptions. But the other ones are essentially flat or down. So that doesn't really give encouragement to the other tech names that are maybe waiting to come out that aren't an AI story like ARM was, to how well they're going to do. So that's something that gives me a little bit of pause as I think about the pipeline of names that have been discussed as coming on in the coming months.
One other big theme, obviously we talk a lot about the show, I want to get your take on it. The Fed, higher for longer, that's the mantra. Is that a big topic in your world, Cameron, that you think a lot about? Does it impact you as a venture investor?
Yes and no. I mean, it trickles down for sure. It impacts the broader market, it impacts the stock market. And the stock market, in effect, is the downstream, or upstream, however you want to define it, for the venture market. And so, to the extent that investors are wary about making big bets in equities because they feel like there's better opportunities maybe on yield to do things in the bond space, of course that's going to impact the venture space as well. It's not something we discuss day in and day out. I don't meet with founders when they're talking to me about interest rates, unless it's a lending business, obviously, which within fintech is a meaningful part of the space.
Cameron, it was so great. I had so many more questions, but we'll leave it there. Thanks for coming in.
Thank you.
Appreciate it. Moving on, Yahoo Finance's Jared Blickery is joining us here now with more on the trading day takeaways. Jared.
Bad day for semis. In fact, I'm calling it the chip-pocalypse, and I say that a little bit tongue-in-cheek because it was not a disaster, but we're not used to seeing this much red on our heat maps screen, and there you can see it right there. Just want to quickly plot the price action in Nvidia, and I'm going to show you a 2-month chart with candlesticks so you can see this big red candle right here, and I want to show you another one. On a year-to-date chart, you can see we have one right here, so sometimes these are the beginning of a consolidation or minor correction period, and Josh, that's what we could be seeing here right now.
How about AMD? Wasn't that another name on your radar?
You know what? Look at AMD. Look at all this red on the screen. There's AMD. Yeah. My guess is this is the reaction in some kind of pairs trade. You can see it's up today, 4.62%, up 10% year to date, but that is a far cry from Nvidia. By the way, I got to mention too, tomorrow is a huge options expiration and also a rebalance for a lot of S&P indices. So Nvidia has been there's kind of this virtuous cycle. This is a year-to-date chart where people are buying call options in Nvidia, and the dealers, the market makers who sell those call options, they have to cover them, and they buy the underlying stock. And so this creates this virtuous cycle of higher prices in the stock. That's going to stop tomorrow so that on Monday, Nvidia is going to be able to trade more freely to the upside and to the downside.
All right, a lot to watch. Jared Blickery, point number 2.
You bet. This is something funny I came across in a Goldman note. This is the yachts versus the have-yachts. Normally we talk about the haves and the have-nots. No, this is the yachts versus the have-yachts. And here we have the earnings revisions. This goes back to June of last year, and we have the top 5 stocks in the U.S., Microsoft, Nvidia, Amazon, Google, Meta, versus the rest of the S&P 500s, and these are earnings revisions. So we can see on those top 5 stocks, that's up 38%, and the 495 down 5%.
Does that surprise you?
What surprises me is that the gap is actually this big.
Yeah.
That is just a huge chasm there, and it makes you wonder, are any other stocks participating in this rally besides those 5? The answer is yes. So, on average, maybe the average is 0, but there's some more stocks that are participating. But just real quick, this also ties into one more phenomenon, and that is the Dow versus the Nasdaq. Today, guess what? The Nasdaq was down 0.8%. The Dow was up 0.8%. So all kind of ties together here.
All right, the final Jared Blickery point.
Yes. We have bullish seasonality on deck in July. So just thinking a week or two ahead here, for the month of July. This compares the first 10 and the last 10 trading days of each month. So we got 24 bars here, 2 for each month. What you're going to notice is July, that's the first 10 days of July, that is the biggest bar. So going back to 1928, that is the most bullish period to be in the market. Doesn't mean that we have to go up, but that is just a huge tailwind.
Let me ask you, seasonality, we talk about it so often. Isn't that priced in, or why isn't it priced in, given the amount of times we talk about it, Jared?
Yeah, the thing is, I don't know that you can ever price anything in fully. I think it's just kind of a tailwind. So I've seen studies done where it shows that about 1/3 of market gains can be attributed to seasonality, but that's not even close to 50%. So it's just something that kind of helps you along. If there's big news to the contrary, guess what? We're not going to go there.
Now, I want to get out of here. Didn't the great Ryan Dietrich have some other thoughts, I believe?
Yeah, other thoughts that are very similar in conclusion. Can this rally continue? Be aware that July has been up 9 years in a row for the S&P 500, up 3.1%, kind of a similar chart to the one we just showed. In this chart, November is actually bigger, but suffice to say, July, beginning of the July, should be a nice window for stocks, all things being considered equal.
You can always count on Dietrich to come with the data.
Oh, you bet.
Yeah, absolutely.
Bull boss Ryan Dietrich.
All right. Thank you, Jared. And coming up, it is the latest episode of Lead This Way. Madison Mills is getting a closer look at the next AI revolution in healthcare. More asking for a trend on the other side.
So currently what I see is a beating heart, and I do have a little note that's available to me that says it is a myocardial infarction. So this patient's having a heart attack.
Amazon Web Services is extending its reach into healthcare. And it's not just about 3D virtual hearts like this one. From simple voice commands to complex real-time data analysis, AWS, along with other tech heavyweights, is looking to solve some of the healthcare system's biggest issues, including costs and labor shortages. Dr. Angela Shippey, medical doctor turned physician executive at AWS, is leading the charge for the world's biggest cloud provider.
I have the opportunity to really bridge that gap between what's happening day to day within healthcare organizations and technology that can help them really transform and really find the solutions to any pain points that they have.
Big tech firms from Amazon to Meta added $16 billion in AI spend this earnings season, as healthcare spend hit $4.5 trillion in 2022. Yahoo Finance got an exclusive look at how Dr. Shippey sees the future of healthcare. This is kind of a homecoming. Can you tell me your context with this specific hospital?
I used to see patients here early in my career and throughout.
Dr. Shippey spent a decade seeing patients before managing hospitals herself. I know that you've said you knew you wanted to go into the medical field as early as 9 years old, which fascinates me. What would you tell that 9-year-old about why you work at a tech company now?
That 9-year-old wanted to go to medicine then because somebody told her that she was smart, and the 9-year-old thought that smart people became doctors. She would not be surprised that the ability to scale to help more than the 25 people I could lay hands on every day would only occur by working for a large organization like AWS.
Now, Shippey interfaces with 700 healthcare leaders across the U.S. in an effort to expand their use of AWS-backed technology, including two-way communication systems like the Echo Dot, a potential replacement for traditional call buttons.
So right now we're in an inpatient room. The patient can ask for the lights to be turned on or off, the temperature to be controlled. So it's one of the ways that it frees up the clinical resources so that nurses can work at the top of their license by really helping with the true clinical tasks, medications, diagnostic testing, looking at the lab results, interacting with the rest of the clinical team, and it allows the patient to take care of those nice little creature comforts that are theirs.
What is the importance of cost effectiveness too? Not just for things like burnout, but just for the hospital in general?
So when you have the opportunity to visit across the country like I do with hospital leaders, what I see them talking about most is their margin variability, what's happening with their workforce, and what does the consumer or patients and their families demand. So what I see them doing is looking to migrate to the cloud because that allows them to decrease the cost of their IT infrastructure. We know that those organizations that go to the cloud, it's 60% less that they spend in compute, storage, and networking.
Cloud tools like these are digitally transforming healthcare, and the market is getting bigger, with research projecting it to reach over $115 billion by 2030. Microsoft has a strong foothold in the provider space with Azure, its OpenAI service. That's being used by Epic, the largest electronic health record provider, covering medical records for over 300 million patients. How bad of a heart attack is the one that this heart is having?
I would say just based on how it's looking, there's definitely damage to the wall, to the myocardium.
The tech could train providers on procedures and patients on their illnesses.
For a patient who has cardiovascular disease, to be able to show them, this is what your heart looks like. This is what happens when your blood pressure isn't controlled, or you get to the point that you don't have enough blood flow. I could see where it might help a patient be even more compliant with their medical regimen.
Hi, good morning, ma'am. My name is Ashley. I'm a virtual nurse here at Houston Methodist.
Outside of the tech hub, AWS integrates two-way audio-visual tech with cloud service in the virtual intensive care unit. This allows nurses to monitor more patients in less time.
The virtual nurse will ring the bell and let the patient know that they're coming in, and then they'll show up on camera so the patient can fully see them, and then they'll converse. It usually takes 45 to 60 minutes to admit or discharge a patient, and many times they would get interrupted because of other patients they're taking care of or other questions they had to answer from other members of the care team. This way, the patient's getting dedicated time with a nurse at a time that's very critical in either their admission or when they're being discharged home to continue their care.
Dr. Shippey implemented this alongside her former colleague, Roberta Schwartz. The two worked together during the height of the pandemic before Schwartz became CEO of the hospital. In addition to medical accuracy, Schwartz said that AWS cloud technologies have lowered costs of care.
Sitting behind us is, the virtual ICU. And when we built it, we used to have 4 nocturnal intensivists on site here. We now have 2. That means that 2 people are sleeping through the night in a much better way. They're less burned out. We were able to have adequate and appropriately staffing during the daytime, reducing our code blues by 20%, reducing our length of stay, improving many other aspects of the quality of care.
When Dr. Shippey isn't at the Texas Medical Center or hospitals around the country, she can be found in Houston. Here at the AWS office, Yahoo Finance got a closer look at how she transitioned from practicing doctor to innovative leader at Amazon Web Services. One thing I'm so interested in is how you made the decision to go over to the tech space when you had interfaced with patients for so long. Can you talk to me about what that decision-making process was like for you?
Truly in my career, I've been an end user of technology the entire time. So along the way, I've been a champion to pilot devices. I've been a champion for documentation electronically. And so it's just been part of my world. I saw the power of technology and how it would be used to transform healthcare. And that's really what made coming to a role like this at AWS possible for me, because I saw what that transformation could really lead to.
I'm curious what that's like for you, kind of this idea that you speak 2 languages fluently. I mean, several, but like the healthcare executive, but also the practitioner.
So one of the reasons why I do what I do every day is in my role as a clinician, I certainly saw opportunities for us to do things differently and to do them better. And I also once had somebody tell me from a software company, the product is working as designed. Well, it was working as designed, but it wasn't working for me and my healthcare colleagues who were actually taking care of patients. So I wanted to be able to sit in the seat where I could help new technology, new innovations make sense for those who would be using them, for the end user, the clinician.
Shippy believes accessibility could help change the conversation for patients who view the system as broken. From long waits to short appointments, over 70% of Americans feel the healthcare system is failing them. Much of the frustration is felt due to supply and labor shortages that remain a problem in the field. 56% of hospitals' total operating revenue goes to labor, and a key challenge is turnover, as staffers are leaving while there's an uptick in patient volumes.
If we can take away those tiny administrative, burdensome tasks and allow them to do what they truly love, then we know we're making it a better experience for them, and we're making it a better experience for the patient as well, because they're in control.
Dr. Shippy hopes to drive better patient outcomes by prioritizing the needs of practitioners with things like more flexibility and allowing them to work at the clinical level.
One of the things that's really important when you're talking with patients is not to make an assumption. If you listen to patients who have heart attacks and listen to them tell you their story about their symptoms, sometimes it'll sound just like the textbook, and sometimes it won't. And it's really important to listen to the story, listen to the patient. So the history, the physical, looking at all the diagnostic tests, and then bringing it all together to say, this is the differential diagnosis, and this is the ultimate diagnosis and what's going on with this patient.
Raising the profile of women and minorities is another passion of Dr. Shippy's. As of 2023, women hold 35% of tech jobs in the U.S. The representation of women drops at senior positions in healthcare organizations. Still, Dr. Shippy remains optimistic about the potential tech has to represent greater populations.
Now what we're seeing is the majority of healthcare decision-making happens by women. The largest part of the workforce in medicine is nurses. So what I see changing along the way are people being more inclusive in their thought about how do we ensure that women have a place at the table, and women are the ones that are there making that happen. The top of our game will not always mean that we're at the head of the table, but it means that we're definitely involved in the decision-making, we're helping set the strategy. And when you say, like, somebody like me at 9 years old says, I wanna be a doctor, I wanna help people, like that never goes away. And one of the things that becomes very, very clear is when you have good health, then you're able to do anything that you need to do. And so being from an underrepresented community or being in a community where maybe healthcare isn't like what you've seen in the Texas Medical Center today, we wanna close those gaps.
McDonald's is falling behind Burger King in same-store sales growth in the U.S. This coming as the fast food value meal competition heats up, with McDonald's $5 value meal set to take effect on June 25th. And Yahoo Finance's very own Julie Hyman joins me now with a closer look. Julie.
Yeah, this helps explain what's at stake with these sort of new value meal wars, so to speak, as the McDonald's for the past few years has pretty consistently been on top in terms of its same-store sales. But now that has changed, and we'll see if it's sustainably changed. But McDonald's U.S. comps 2.5% last quarter. That compares with Burger King's at 3.8%. Wendy's still lagging here at 0.6%. But this does help explain why we were seeing this flurry of activity around value meals being introduced. So next Tuesday, McDonald's going to kick off its new marketing campaign around this new meal deal, which is a $5 meal deal. It's in response to some of its competitors, right? You're getting a Wendy's $3 breakfast value meal. Even Starbucks has now a $6 breakfast sandwich and coffee meal as well. Burger King also has been pushing out some value. So there's that element, but there's also sort of the social media surrounding McDonald's itself. Recently, of course, there was that social media post that highlighted an $18 Big Mac meal, and the company's pushed back against that, said it was an anomaly, but nonetheless, this all seems to be somewhat connected here. We'll see how consumers react to this latest meal deal. We'll also see how franchisees react to it, because sometimes these types of value meals are not necessarily popular because it threatens the margins for some of these franchisees, Josh. So it'll be interesting to see how it all plays out, and we'll see if it helps juice these sales for McDonald's.
$5 meal deal. Viewers want to know, what do I get for that? Here's what you get. Apparently a McDouble cheeseburger or a McChicken sandwich, small french fries, my personal favorite, the 4-piece chicken nuggets, and a small soft drink. Are you in, Julie Hyman? Are you in? Does that make sense to you? Do you want that?
No.
Really?
No, I don't, but I know you do, and you will order more than enough for me.
I'm going to have enough for both of us. Julie Hyman, thank you so much. Appreciate it. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market-moving stories affecting your wallet. Have a great night.